But silver is no longer just an industrial metal. It's behaving like, sound money. And the world is waking up. The squeeze is on. And the reset isn't coming. It's already begun. Now is the time to get physical metals, sound money, gold and silver back in the system. Must be redeemable.
I think this is going to continue until gold makes up probably 50+% of global reserves, and gold's going to need to go to probably $6,000 to $8,000 an ounce in order for it to do that. And that's just some simple math. But what's interesting is now that I've been watching this trend for the last couple of years.
Lynette Zang and Brettheath bring forward a powerful reminder that we're no longer waiting for a monetary reset. It's already unfolding around us. Silver, once viewed primarily as an industrial metal, is beginning to reclaim its role as sound money. Moving in tandem with gold as the world questions the sustainability of fiat systems. The market dynamics have shifted. Investors are realizing that physical metals are not just commodities, but anchors of real value in a volatile financial landscape. According to their analysis, this growing awakening is driving what can only be called a monetary squeeze. As central banks quietly expand their gold holdings, the world edges closer to a system where tangible assets underpin financial stability once again. For gold to represent 50% or more of global reserves, its price would need to reach between $6,000 and $8,000 per ounce, a projection based not on hype, but on straightforward macroeconomic math. The transition is already underway. Confidence in paper promises is eroding, and the return to redeemable physical value is gaining pace. The reset isn't coming. It's here. If you value financial truth and real assets, make sure to like, share, and subscribe for more essential insights.
After 45 years under a resistance level, silver sprinted past that $50 an ounce. And that's a very big deal. Now, some call for 400, but even that doesn't really reflect silver's true fundamental value, frankly, as sound money that holds your purchasing power intact. It'll express to that. But unlike paper dollars, quite honestly, silver is real. It's limited. It's trusted. And frankly, it's a diminishing asset since it gets used up in manufacturing. And now that it's broken free, the race for the physical metal is on. Backwardation. We have to talk about this because what that means, very simply put, is that today's price, the spot market, is higher than the price in the future, which is unusual. It's like an inversion. In fact, it is like an inverted yield curve, and that is a signal that something unusual is happening. It's changing. Because normally futures cost more due to storage, insurance, financing, et cetera, et cetera. That's called contago. But when people pay more to get silver now than later, that's a sign of urgency and scarcity. So big backwardation doesn't happen by accident. It's the market's way of flashing an SOS. It means something serious is happening beneath the surface. Frankly, something that can't and shouldn't be ignored. Because when spot leads and futures lag, it's a sign that paper pricing is losing control. And that's really the biggest part of the U.S. market. And it didn't just start, it started last January. And so backwardation shows up, especially when as large as silver's current $2.88 gap. That's huge. It's the market flashing red alert. And what is it saying? Demand for immediate metal has overwhelmed supply, and something big is shifting in how silver's price is being discovered. You know, the paper markets, that's a trading market. Yeah, well, that's shifting, and you better get on board. Because when the futures curve flips this hard, it usually means three things. Supply is under stress. Demand for physical silver is surging, and price discovery is breaking down. A reset is coming in how silver and gold, frankly, are going to be priced. Buyers are paying extra for same-day delivery because they can't afford to wait, and they don't trust that the metal's going to be there when they're ready for it.
This has been one of the most ignored bull markets I've ever recognized or seen in my career so far. To see gold go to $4,000 an ounce before kind of the generalist asset managers just start to wake up is just mind-boggling. But they are woken up. We are kind of in I would say, this awareness phase. If you look at kind of market psychology of bull markets, there's always this kind of awareness phase. It seems that we're kind of in the middle of that awareness phase at some point in time, but we have not even started the mania phase. The mania phase is typically when you get all of those capital flows coming in. We have not seen that. You look at the Dow to gold ratio, and that's the other thing to kind of keep in mind. You got to put it in perspective, because looking at everything on a US dollar basis in the midst of this great debasement, it can fool you. It can really tell you a different story. So it's important to look at the ratios. And when you look at the Dow to gold ratio, that peaked in the last bull market around 6, meaning that 6 ounces of gold basically equaled the Dow. That was in 2011. Historically, that has gone to 1-to-1 in the past, but we're still sitting around 11 right now. When you look at the XAU, which is one of the longest kind of standing gold indexes, versus gold. So basically, these gold stocks priced in gold, like, we're just barely off the bottom still today, even with these substantial moves. So I would argue that that there still is a long way to go in this bull market. And I think that, again, the corrections are going to be shallow to the point where a lot of investors are going to miss them altogether.
After more than 4 decades of resistance, silver's breakout beyond $50 an ounce marks a defining moment in monetary history. This isn't just another rally. It's a structural shift signaling that the metal's true. Fundamental value as sound money is reasserting itself. Unlike paper currency, silver is finite, consumed by manufacturing, and increasingly scarce. The appearance of backwardation, where spot prices exceed futures, is a flashing red alert from the market itself. It shows that demand for physical silver is overwhelming supply, and that paper price discovery is losing control. Such inversions are rare and powerful. They point to a breakdown in trust across futures markets, as buyers are willing to pay more for metal they can hold today than contracts promising delivery later. This is how markets warn that something deeper is shifting, a reset in how value and money are defined. At the same time, gold's climb past $4,000 is waking up a new wave of investors. But this is still just the awareness phase of a much larger bull market. The mania stage is yet to come. The correction windows may be brief, and those waiting too long may miss history's next great move. Let's get into the interview.
If you look at the Q3 central bank numbers that just came out yesterday, and we saw a record amount of tons, I think it was 1,313 tons, but it increased 44% year over year in the dollar amount. So significant amount of buying. But what is this? It's obviously price insensitive buying, because you're getting gold going at all-time highs. You're getting this type of physical demand across the sector. It's a transition away from U.S. Treasuries, and so this is happening. It's continued to happen, and now U.S. Treasuries, gold makes up a greater amount of total reserves as compared to U.S. Treasuries by itself. You still have U.S. denominated assets as a whole making up a larger portion of gold, but you've got $370 trillion of financial assets, and that is transitioning to tangible assets. I think that's kind of the bigger trend. And we live in a world today where there are no more bond vigilantes, and so where is this inflation? Where is this, call it, monetary debasement trend showing up? Well, it's showing up in gold. And as a U.S. citizen, like, you look at everything in your own currency, and other countries kind of vice versa. But in reality, when you look at kind of this broader trend, I think that it's showing up with gold now, but it's going to be going into all other tangible assets. I think copper is another one, but commodities in general, tangible assets across the board. You look at kind of the performance of the broad stock exchanges and so forth. Like you kind of see this and you're like, okay, well, this is a much, much bigger trend. We're at the beginning stages of it. And I think it's going to continue here. And the mining sector hasn't even begun to start thinking about planning or mine planning at even above $2,000 gold. I mean, you're still seeing most mines being planned sub $2,000 gold. And as these mining companies start to get, or these executives at these mining companies and these boards start to get a little bit more comfortable with gold where it's at and that it's not going to come back down, because again, if you look at kind of how these mining companies are priced right now, like they're priced at a much, much, much lower gold price, which is reflecting the value. But as they start to think about planning at a $2,200 gold price, what does that do to ultimately to the reserves and the resources? I mean, it significantly has an impact on how they look at that. You're going to see very, very large expansions, and the royalties cover all of that. Like the royalty covers all of that upside. I think we're at the beginning of this cycle right now. I think it's going to take probably, I mean, I'm hearing right now a lot of executives in their budget meetings for 2026, their heads are just absolutely spinning because they just don't know what price to use and how to plan for these assets going forward, just given that the volatility has been so extreme over the last 18 months. And then the sector has been burned in the past by getting too aggressive. So I would say generally the sector has been very, very conservative, but there is enormous amounts of optionality and kind of embedded value that just is not even remotely close to kind of surfacing within these markets right now.
Recent data from Q3 confirms what many in the precious metal space have anticipated, representing a 44% year-over-year increase in dollar value. This level of buying, especially near all-time highs, isn't about price speculation. It's price-insensitive accumulation. It reflects a profound shift away from U.S. Treasuries and into tangible reserves like gold. We're witnessing a transformation in global wealth strategy. With over $370 trillion in financial assets now starting to rotate toward real, tangible assets, the trend is undeniable. The bond vigilantes of old are gone, and the inflationary pressures of currency debasement are showing up, not in the bond market, but in gold's relentless rise. Yet the mining sector is still lagging. Most mine plans remain priced below $2,000 gold, even as the spot price stabilizes far higher. As producers adapt to this new reality, we're likely entering the early stages of a gold and commodity supercycle, one that will redefine resource valuations across the board. The groundwork is being laid for massive expansion, and investors who understand this shift are positioning early. If you enjoyed this analysis, don't forget to like the video, subscribe to the channel for more market insights, and share your thoughts in the comments below.